Thank you, Paula. Thank you, everybody. My name is Nachu Chockalingam. I'm one of the portfolio managers at Federated Hermes in London. Delighted to be here with my colleague, Angelo. We're going to focus a little bit more on the fixed income markets in terms of how fixed income can help in terms of financing policy agenda towards achieving net zero. But first, let's start with the quantum of the... It's not moving. There we go. Let's start with the quantum of the problem. So Janet Yellen at her speech last year at COP26 said, in order to achieve the goals of Paris, essentially we need to find $125 trillion of capital. It's a huge amount of money for any one party to find. So clearly the public and the private sectors need to work together to make these initiatives actually happen. She was very keen to emphasize that in her speech. And during this presentation, I will focus in terms of how the fixed income spectrum, particularly the more liquid parts of the fixed income spectrum, can help in this journey. Laura mentioned it in her presentation, the presence of labeled bonds. This is a new asset class really to the fixed income space. When you think about the history of the market, it's really only been around in existence for about 10 years. So for those of you who are not familiar with this segment of the fixed income market, essentially sovereigns, corporates can choose to issue labeled bonds. Let's just define them. So you have green, social, sustainable bonds. These are all use of proceeds bonds. So if an issuer wants to issue one of these bonds, they must have an environmental or a social project they want to fund, and we as investors will assess the credibility of their plans and assess the pricing of those securities and decide whether or not we want to buy them. So essentially, we as investors are helping to finance change and fighting on the climate agenda points. A newest segment of the market that's really developed over the past 3 to 4 years is sustainability-linked bonds. I'm sure some of you have heard of these in the past. Essentially, these are general corporate purpose bonds. So the issuer raising these bonds can use the proceeds for anything that they want to do so. What they need to be aware of, though, is in order to issue them, they need to articulate a handful of KPIs on the sustainability side that they intend to achieve over a time period. Normally it's 5 years or so. If they don't achieve those sustainability KPIs, essentially the coupon on the bond will step up. So there is some form of penalization for not achieving what you said you are going to achieve. We calculate that since 2010 to the first quarter this year, $4.5 trillion of bonds have been issued in this fashion. So big market, it's growing very quickly, and a lot more issuers are tapping into raising labeled bonds. So you might ask the next question, who are the key buyers of labeled bonds? There has been tremendous growth in global ESG funds, as you can all imagine. A lot of capital is choosing to invest sustainably. Various different elements of sustainability, but choosing to go and invest in this way. Since the pandemic alone, AUM of global ESG funds has grown by 180%. That's huge growth in just 2 years. And even sort of our incoming inquiry on our desk is coming more in the sustainable orientated fashion. We approach this slightly differently. So global ESG funds typically will look at the labeled bonds we discussed on the previous slide and take them as their first investable option when it comes to their fixed income allocations. We are slightly more security agnostic. What we like to do is really assess the fundamental credit quality of a company, layer on what we think the prospects are from a sustainability point of view, and then choose which part in the capital structure we want to invest in. If we like the fundamental prospects of the company, we like the direction they're heading in from a sustainability point of view, our view is let's buy the widest spread instrument or the highest yielding instrument in their capital structure. And by doing so, we think we can generate 2 things. Number 1, returns for our investors, but also ultimately returns to society. We have a mantra on our desk which discusses the point around exclusions versus engagement. And we'll talk more in detail about this, but essentially we believe that engagement matters. We like to invest, engage, change, perform. A lot of people question the validity of fixed income engagement, and is it as impactful as equity engagement? I guess our answer is every stakeholder, you could be an employee, a government organization, a supplier to a company, everyone has the right to engage. So fixed income engagement does matter, and it can sit quite nicely alongside equities, and we do show impact from what we are able to achieve. Two key ways in which we show impact is, number one, fixed income is a recurring source of cash for a company. Companies can't issue bonds for perpetuity. They can, but not all their capital structure can be structured that way. So they constantly need to come back to the markets for refinancing. And that's a good point in time for investors like us to talk to companies about their philosophy around sustainability and make sure they're on track in terms of what they say they are going to do. I think I'm speaking to most of you in this room who are believers in all this. A lot of people worry that when they invest in a sustainable fashion, they are forsaking financial returns. We firmly believe you are not. We think, financial and sustainable objectives are not mutually exclusive. In effect, they work well and work with one another. As a company improves its sustainability profile, its ESG metrics will get better. It is in effect de-risking. Because it is de-risking, its enterprise value is going higher, its cash flows are getting better, and ultimately that will be reflected in the valuation of its securities. So we firmly believe that by investing in this way, you are not forsaking any financial benefit. When we think about a credit portfolio, so here I'm talking predominantly about corporate bonds, sovereign bonds, etc. There are various different ways in which you can create a portfolio that is aligned to a decarbonisation target or threshold. There are three real main methods you can achieve this. So firstly, you start green and you stay green. So essentially here, in this sort of portfolio, you are buying companies that are already leaders. They're already doing lots of good things, but the valuations may be tight, reflective of the fact that they are already doing very good things on the sustainability side. The second option is to start brown and essentially transition to green. In this situation, what you are doing is you are buying transitioning companies. Transition leaders is what we call them. They are companies on the right pathway, but maybe very early stage. So there is still some time for them to progress to see the benefits come through. And the third option, slightly more controversial, is you start brown, but you trade into green. What do I mean by this? Essentially, you could start with a portfolio of securities in very high emitting sectors, say steel, for example. But you then convert that portfolio into a portfolio of assets maybe in the TMT space. What you have done is you have decarbonized, but the only way you have got there is by trading out of one sector into another sector. So that's something really important to watch when you're looking at portfolios, you're looking at investing in, because you want to be aware that that third option is sometimes used as a means to achieve results on the sustainability objective side. I'm sure all of you have heard of science-based targets. We believe science-based targets are one of the best leading indicators of a company's decarbonisation potential, especially when those targets are validated and verified by third parties. We have a great degree of confidence in terms of what that company can actually achieve. The initiative actually put a study about 2 years ago, and essentially the conclusion of that study was, if a company sets science-based targets, it will decarbonise at a rate of roughly 6.4% per annum, which is greater than the 4.2% needed to meet the 1.5-degree scenario target. So first and foremost, we really emphasise looking for science-based targets. We encourage companies to set them, and we do believe that they are the most important factor to consider when you're thinking about decarbonisation. Now, there is a lot of third-party data when it comes to assessing climate potential, impact that companies are having. But there are two issues with using a lot of this third-party data. I'm sure all of you have heard of providers like MSCI, Sustainalytics, Truecost. I can name probably half a dozen others. The problem is a lot of the data that you receive from these third-party providers is somewhat backward-looking. Scores and data you are looking at today is of information that the company might have produced 12 to 18 months ago. But actually, companies have done quite a lot since the last time they were assessed properly. So there is this lack of real-time data, effectively. And then the second problem is there is huge dispersion between different data providers. One could say one very good thing about a company, the other comes with a very different conclusion. So what we have done in-house, because we run a lot of climate-themed mandates, as we developed our own scoring process. It's called the Climate Change Impact Score. We take in all of this third-party data because we do think it's very important to assess it, but then we overlay our own qualitative analysis that largely comes from our team of in-house engagers who are talking to companies on a daily basis around what they're doing regarding their decarbonisation strategy. By taking in this engagement analysis, we're able to have a much more credible view in terms of what the company is likely to achieve going forwards, and particularly in our climate-themed mandates, where we have to essentially have a financial outcome, but also a sustainability outcome that is usually, footprint or intensity linked relative to the benchmark we're using. It's really important to do this analysis. We essentially assign all companies that we invest in a score of 1 to 5, and that helps portfolio managers assess what they can include in portfolios, but also how to weight those particular names in order to show the impact they're having on the secondary objective. The two key factors we look at when we think about the climate change impact score is the ambition a company has when it comes to its decarbonisation strategy. So our engagers will be looking at the public announcements that they have made, assessing the credibility of those announcements, what are the targets, what temperature alignment are they looking at, and how do they rank relative to their peers. The second aspect is the materiality of expected impact they will have. As you can imagine, certain sectors, especially from a decarbonisation point of view, have much greater impact than others. So we have to look at it on a relative basis. But essentially, in that section, what the engagers are looking for are, is the company actually putting money to work to make these action plans actually happen? And looking at what they've said in the past and have they delivered on what they've said in the past? So it's really important to think about it in that sort of context to really get a sense as to the credibility of what the company is trying to say. So let's take the energy sector, for example. Controversial sector, but obviously very key to ascertaining the leaders and the laggards in that space. So questions they'll be asking issuers in order to determine the scores they give them will be things like, how aligned are you to the IEA 2050 proposals? How much are you investing in renewable energy? How much capital are you putting to work in terms of your financial commitments? What is your methane emission management program like? Those are the sort of questions they want to be getting good answers to in order to be getting a high score, particularly in the hard-to-abate sectors. Just very briefly on our investment process, we are ultimately credit investors. We want companies, we lend money to companies, and we essentially want companies to pay us back. And in the meantime, we will get paid the coupon that they are paying us. So getting the corporate fundamentals right is ultimately the first job we have to do. There is no point really going to step 2 in terms of assessing E and S objectives unless you've got the corporate fundamentals right. So that's our job first and foremost. Once we are comfortable that the company's leverage profile is okay, its liquidity is good, it's able to service its debt, we can then move on to layering on our sustainability agenda and the actions that we want to see from that particular company. But ultimately, by doing this 2-step process, we feel we can deliver returns not only to our investors, but also overall returns to society. We also look at things through the SDG angle. We take a slightly different view from Dimple. What we do is essentially we use the SDGs as a way to identify, articulate, and measure the impact we are having. Obviously, they are very key to a lot of the investments we are making. What we do is, this is all managed by our in-house team of engagers. They will assign 3 to 4 different SDGs that are most relevant to a particular company in order to keep the engagement really focused. And they will focus on improving or helping the company improve their progress in terms of meeting those specific SDGs. So we're not looking at all 17 for every different company. We'll pick the 3 or 4 most relevant ones and focus on them. The key thing here is we want companies to be in a position where they can report on the results that they have actioned, but also want to continually talk to investors like us because, right now we feel like companies can only get better. There's nobody who's perfect already. So even companies that are leaders, we still feel like we can have some engagement discussion with them and make them even better. Now, When you think about the thematic of sustainable investing, we discussed earlier exclusions versus engagement, and our preference is definitely more for the engagement angle. But let's think about it in the context of a climate portfolio. If you go down the values-based exclusions route, what does your portfolio look like? Well, essentially, you are probably going to be excluding hard-to-abate sectors and companies. So no fossil fuels, probably no sin sectors, and you're going to be excluding really laggards from a data perspective. The benefit of doing that strategy is you're invested predominantly in leaders, so hopefully not too many things that you need to worry about. The negative, though, is because you are not invested in the hard-to-abate sectors, you've essentially lost your right to engage with those companies. There is still this fallacy that you need to be invested within a company in order to have a voice to start talking to them about somewhat difficult issues. The alternative is to engage with companies. In a climate portfolio, for example, when you layer on engagement, essentially what you are doing is you're talking to companies to try and make them better. So in this context, you'll be looking for credible transition leaders. You're looking for companies that are on the right pathway, but not maybe at the best in class of what they can be. The benefit of that sort of strategy is you have a seat at the table when it comes to discussing somewhat difficult issues with companies. The negative, though, is your end investor must be comfortable with a brown to green portfolio and the volatility with what comes with that, essentially. The decarbonisation pathway is not always linear. It can be up and down sometimes as well. Ultimately, both options are viable, both options are of interest to lots of different parties. We notice actually as we go around the world, actually some countries are more exposed to exclusions versus engagement. So it does vary, but obviously both considerations need to be taken into account. And ultimately it's the end investor who has to think about their exposure to hard to abatement sectors and what they actually want to achieve. Just lastly, I put in a handful of case studies. These are all in the presentation outside if you would like to think about, look at them in more detail. But just to put into practice a little bit of what we end up doing. So I don't know if many of you are familiar with this company called Suzano. They're a pulp and paper company based in Brazil. They're actually one of the largest in the world. And interestingly, for an emerging market company, actually at the leading edge of climate enhancement, what they're doing. They're actually much better than some of the European companies that we've looked at in the past. What is interesting to me about a company like Suzano is fundamentally they are very solid. The balance sheet is strong, liquidity is good, they have a very low operational cost base. On the engagement side, we have been so pleasantly surprised at how engageable they are and how forthcoming they've been in terms of setting targets. This is the first company I've seen recently that has set a carbon positive target. Essentially, they want to sequester more carbon than they actually emit. Almost all of their production is FSC certified, and this is the sort of company that will benefit from the mega trend away from plastics. So this is a company that we really like in our carbon portfolios, but also across the board. It'll be sized differently because it's more impactful on the carbon side, but it's a really interesting case study to look at. The second company I picked was KB Homes. This is probably less familiar to many of you here. They are a home builder based in the US, focused on the first-time buyer market. The reason why I picked KB Homes is really to articulate the fact that SBTs make a difference. These guys were the first in the US home building space to set science-based targets. And we can see, because they've set them, actually their intensity levels have diminished so much faster than their peer groups have. So just to reference the point I made earlier in terms of how science-based targets make a difference. And then there we go. And then just the last one I wanted to mention was just Barclays. Everyone is probably aware of this bank. But financials, when you think about financials and decarbonisation, it doesn't always make sense at the beginning because actually a bank by itself, the footprint is actually quite small. What can you do? You can really discuss, carbon intensity of your trading operations, energy efficient management of your offices, etc. So there's not a huge amount you can do directly. But where financial institutions become very key is in their financed emissions and how they're dealing with the reduction in scope emissions in their financed emissions. And Barclays is probably the leading bank in that space, particularly when we think about the European context. They've set a goal that they want to be net zero across all of their financed emissions by 2050. They're actually quite a far way down there. So this is looking at their portfolio book and all of their standalone operations, all their branches, etc. And we use Barclays quite a bit to talk with other banks about what potentially can happen, because banks will be key in terms of changing mindset around investing going forwards and the projects that they are willing to lend to. Because while we on the corporate credit side are one part of the market, we're a very small part of the overall fixed income market. So banks and their lending books will be very key for that. That's all I had to say for this presentation, but there is a panel later on, and obviously very happy to take questions anytime.
We have time for a couple of questions, if anyone is.
I was just wondering, at what stage do you invest? You've talked about countries and some companies and some case studies. But I was just wondering, at what stage do you start investing with debt?
So we're bond investors predominantly. So essentially we can invest at any point in time that the company is issuing a bond. We could be looking at very old issuers like Barclays who have been in the market for years and years, or we could be looking at new issuers that are coming to market right now. The one thing I would say is, we have this credit rating spectrum that goes from A all the way down to D. The part that is hardest to work with is really that low end of the spectrum, so the single B, triple C aspect, because there, essentially, you are dealing with companies who are, thinking about survival. They're very stretched in terms of their balance sheet. So discussing sustainability with them is sometimes not fruitful because they're not really there in terms of wanting to take the next step forward. So we tend to focus on the upper parts of the credit rating spectrum, so double B and above. We think we can have much more impact there than we can lower down the rating spectrum.
Yeah.
Zou willen gaan staan voor de camera. Alles voor de kijkcijfers. Thank you. The government of Amsterdam has the ambition to become a city donut, as the famous writer is, the author is Kate Raworth. And part of the city donut is also to talk about degrowth. And the government launched an investment fund to finance degrowth. Are you also thinking about this kind of funds?
Actually, no, I haven't heard of that before, but it's a very interesting concept. Yeah, we haven't thought about it.
Thank you. Thank you very much.
Thank you.
Nachu, that was great. Thank you.